The stock market's watchers are raising their horns in protest, saying, "I personally think we are in maybe the biggest bubble of my career." Investors loaded up on risky assets like housing, tech stocks, and even cryptocurrency. Asset valuations are somewhat elevated. The cryptocurrencies that are really a speculative assets, I do think they are risky. They're not backed by anything, Jerome Powell said. Many feel that the financial crisis began at the nation's largest bank. It's all under control of the Fed. Included in this is any and all of your cash stored in bank vaults to help out in times of need. They have the ability to print more. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. For the previous 2 decades, the US Central Bank has kept interest rates on loans as low as feasible. They also bought bonds, which flooded the market with more cash. The Fed's bond portfolio is now at an all-time high, totaling about $9 trillion in assets. Policymakers now use the balance sheet more than it used to. In an effort to improve the economy, the Federal Reserve is leveraging its balance sheet. According to former Federal Reserve Vice Chairman Roger Ferguson Jr., this bond buying operation, which has pushed the market to new highs, ought to be stopped as quickly as possible by the Federal Reserve. Analysts expect that the federal government's bond portfolio will shrink by $2 to $3 trillion over the next few years. Doing so would stabilize markets. But there is a risk that if the Fed eliminates emergency stimulus too quickly, it might cause a recession. It is difficult to raise interest rates and tighten monetary policy enough to keep inflation under control while avoiding a recession, and history is not always on their favor. Greg McBride stated this. So, how did the Federal Reserve acquire nearly $9 trillion in assets? And are they able to resell them without causing a financial crisis? Federal Reserve is a central bank of the United States government. After a catastrophic financial crisis, the Federal Reserve was established. During the 1907 financial crisis, the United States lacked a central bank, and a massive study determined that the key to preventing similar crises in the future was the establishment of a central bank that could generate additional money in response to market pressures. The Fed's most essential instrument is the interest rate on the federal funds. The Fed funds rate is currently between 0% and 0.25%, which is the lowest it can go. The Federal Reserve determines the overnight lending rate between banks, which was unusually low for the time period of the crisis. As a result of short-term interest rate, all of the other interest rates that people pay for are derived from it. All rates are, however, mostly determined by that short-term overnight rate that the Federal Reserve publishes. Because of extraordinary financial conditions, central banks around the world have kept interest rates low to spur further expansion. Rather than utilizing negative interest rates to stimulate the economy, US bankers have relied on mechanisms like bond portfolios and balance sheets to give economic stimulation instead. All banks have a balance sheet, which lists their assets and obligations. One of their key liabilities is the Federal Reserve notes that are currently in circulation. On the asset side of the balance sheet, the Federal Reserve has bought government securities and some mortgages to back up the liabilities, such as the currency in circulation. During a financial crisis, the Federal Reserve has the stability to generate additional money, making it the lender of last resort. The lender of last resort was in many ways that the original function of the Federal Reserve. We didn't want to have a central bank originally, because we worried about there being so much power aggregated in that way. But we needed this function since we might as well have it put in place in a way that allows oversight and accountability. The Columbia Law School's Catherine Judge was quoted as saying this: "Since its inception, the Federal Reserve has rarely used its balance sheet. When the housing bubble burst in 2008, Dr. Ferguson resigned. The federal investors were on edge as they watched the real estate sector begin to withdraw from the whole market in that episode. In order to avert a full-scale financial catastrophe, Federal Reserve Chair Ben Bernanke authorized a large-scale purchase of bonds, which increased the balance sheet swiftly. The premise behind quantitative easing, which pundits refer to as purchasing safe assets, treasuries, and agency mortgage-backed securities, was that by doing so, the Federal Reserve would be able to stimulate greater credit creation and hence more economic activity. Investing in bonds provides investors with a small but safe return. To many investors, treasury bonds offer a safe haven known as riskless assets. The Federal Reserve buys a large percentage of conforming mortgages, which are among the most liquid and deep water borrowers. When the Federal Reserve gets into the market, it takes the secure bonds, making earnings on them decline for everyone. Many traditional investors recommend using a portfolio that balances bonds against stocks. As a result of having nearly $9 trillion balance sheet, you've started to see a lot of odd things happen in the financial markets. In 2020, and especially in 2021, a lot of money was raised by startups that didn't have much of a business model. many investors will be left holding the bag if those ventures go down. As a result, the financial markets have become dependent on the Fed's purchases. By making the Federal Reserve so central in the efforts to get money to companies in the spring of 2020, in the summer of 2020, we did create an overall environment where we did far more to backstop some fragile financial intermediaries. So if you were a large company, regardless of whether you were highly creditworthy or a not so creditworthy large company, your ability to raise money by issuing new debt over the past couple of years has just been astounding. Judge made the statement. The central bank review on unconventional assets, such as securitized mortgages, controversy has erupted among certain people about this. Markets were cautioned by the Federal Reserve that it was time to reduce its balance sheet. Panicked day traders as a result. When investors learned that one of the world's largest buyers and holders of government debt, in particular, and mortgage-backed debt, has suddenly stopped buying and could start selling, they panicked and rapidly reversed course. For, several years later, they started to gradually remove bonds from the balance sheet that were maturing. Greg McBride stated, Bernanke's policy was successful, and market valuations were at an all-time high. When the euphoria wore off, there were signals of a sluggish unwinding of the central bank's balance sheet beginning in 2018, before a new set of warnings appeared in 2019, towards the end of 2020. A new round of bond buying was triggered by the pandemic. Government bonds and mortgage-backed securities were taken off the market by the Federal Reserve for a second time. Financing facilities for municipal and corporate bonds have also been established. Immediately, following the market's abrupt fall, the 2020 bond purchasing program prompted a flurry of new investment activity. Holding such a large balance sheet of nearly $9 trillion has contributed to this environment, where a lot of money flowing into risk assets, and you started to see some crazy things, like cryptocurrency or even NFTs. I think a lot of the fervor for those has been driven by this ultra-low rate environment, where the pursuit for return meant going into risk assets. According to Greg McBride, big corporations benefited from the large financial injections, whereas smaller enterprises were hurt by the large injections. With the Main Street lending facility, we realized that the Federal Reserve didn't have the right tools to aid small and medium-sized firms. In addition, the Fed lacked the necessary capabilities to assist with this. As a result of these, open-end bond funds and ETFs that are backed by bonds, we don't want the financial system to grind to a halt because it lacks liquidity, and we don't want to force a recession as a result of a breakdown in the financial system. Federal Reserve members feel these asset purchases are necessary because they believe that the obligations will be paid when they are due. In the aftermath of practically every major crisis comes a survey, a commission, or a decision by Congress to reorganize the government's resources to better deal with the problem. Our pandemic asset acquisition program will come to an end, removing a further unwanted source of economic stimulation. Members of the Federal Reserve Board, such as Michelle Bowman, believe that the actions that they have taken will reduce inflation in the months ahead. It is anticipated that the Fed will dismantle its asset holdings more quickly than it did following the housing catastrophe. All of us may find that the cost of a loan, the interest rate on a loan, and the cost of borrowing are rising from historically low levels. A rise in interest rates for both homeowners, mortgages, and corporate borrowings has already been observed, and this trend is expected to continue. In this cycle, the Fed intends to reduce its bond holdings by $2 trillion to $3 trillion. An economic downturn could be on the way if the Fed continues to tighten. Are we going to go back to the Fed having a balance sheet of the magnitude that it was in 2006 and early 2007? They are far more doubtful. The function of reserves on bank balance sheets has altered significantly. Judge stated this. It's unfair to suggest that the balance sheet is not designed to be used where it's utilized. It's a new tool, but what's novel about it is that it's being utilized on a regular basis. 2. It's being employed at a scale that was previously unimaginable. Despite the fact that it's out in the open, you might not even notice. Ferguson made the comment. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.